Well, I think that ultimately you can ask for more regulation every day, and what we see is that more paperwork, more regulation is not the solution. Ultimately, the lesson from this episode, which we hope is a single episode and that it doesn't move into other more important players, but ultimately the lesson of this episode is that the policy of central banks is not leading investors to be prudent and to take risk-adjusted bets, but the opposite. The level of beta exposure of hedge funds is unprecedented. Hedge funds are the longest I have seen since I worked in the industry. Longest as in more exposed to the markets. Their long positions and their exposure to the market is much higher than than what they used to have. The same with institutional funds. It's not just hedge funds. It's also the kind of risk that even pension funds have to take in order to achieve a certain level of return, a certain level of yield for increasing risk. Think about this. Even a pension fund that used to be able to generate a 2-3% return for its investors on a yearly basis now needs to be invested in extreme high yield type of bonds or in equities. We have seen that traditional pension funds that used to be 100% invested in bonds are now almost 50-60% invested in equities, and they are more exposed to high yield, which is junk bonds in many cases. So little by little, year by year, in this environment of extreme low rates and high liquidity, what we're seeing is that episodes like this are not a sort of surprise, is that it's a direct consequence of extreme financial repression.
And are you saying there's a possibility that a bigger player in the market might surprise us like this has surprised us? Are you concerned about that?
Well, I'm extremely concerned about the incredible tolerance for extreme risk that is seen not just in hedge funds, which are supposed to be more risky and in which investors are need to be people that are well versed in markets. Nobody can just simply invest in a hedge fund. No. I'm concerned about the level of risk that is being taken from small investors, from retail investors, buying ETFs no matter what, taking aggressive bets on the market as if markets could only rise, buying the most cyclical assets, the most exposed assets to the cycle at any price, at any cost, with very leveraged bets. And those risks may seem irrelevant when markets are just going up all the time. But think of what happened with this particular one. What started the margin call problem came from a snap in a couple of bets. It wasn't even a drastic move in the markets or a crisis or a new wave of the pandemic. It was just a few stocks that went the wrong way, and that triggered a massive 20 billion sell-off in the market. So we need to be repeating over and over and over again that central banks do not mitigate risk, they increase it, and that extremely low rates in an environment of recovery and extreme liquidity generate these types of perverse incentives.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.